Hello everybody. Now let's have a look at the seminar on the topic absorption costing and marginal costing. With the question number 1, you will see that the question asks you to calculate the or to prepare statement profit and loss for April under absorption costing and under variable costing here. So the question gives you more information in order to prepare the statements, and I assume that you've read the question and also you attempted the questions. So we'll look at the answers quickly so you can see if you have the wrong or the right answer here. So now if we start the first statement here, okay, this starts with a statement profit and loss for April under absorption. You need to start with sales, and sales is 75,000. Why? Because 1,500 it's the units sold here. You need to multiply it by selling price per unit, which is selling price per unit, which is £50 here. So that's 75,000. So less cost of sales. Now for cost of sales, you start with opening inventory here, which is 0, and you need to add the cost of sales or cost of good manufactured. For cost of good manufactured, first of all, what you need to do before you prepare the statements, you need to calculate the product cost per unit for the two methods. So if you add up under absorption costing, if you add labor, material, variable production overhead, fixed production overhead, this is the total for product cost per unit using absorption costing, which is a £20 per unit. Under variable costing, what you need to do, if you remember, we need to take away this, the fixed production overhead per unit, the £5. So if you add the first three, £15 is the product cost per unit under variable costing. Okay, now let's closing inventory. Closing inventory is £10,000. Why is £10,000? Because if you look at the question tells you that they sold 1,500. That's fine, but what happened here? They produced 2,000. In this case, they left with 500, and this 500, remember that you need to multiply by 20 the product cost per unit. So now let's come to under or over absorb. Here is under absorb. Why is under absorption cost? Remember something here. So now the fixed production overhead figure has been calculated on the basis of budgeted normal output of 36,000 units per annum. So what does that mean? This means the budgeted units, we calculated the fixed production overhead based on what? Based on the 36,000 units a year. So if you divide 36,000 units, if you divide it by 12, you should find out 3,000 units every month. This is the budgeted units, the budgeted production units. Okay, this is the budgeted production units. So in this case, what you can see in this case, so we are under absorbed. Why is under absorbed? Because the budgeted is 3,000 units every month, but for April we produced only 2,000 units. So as you see, we are under absorbed by 1,000 units, and if you remember this 1,000 units, you need to add it to the cost of production by multiplying by the fixed cost element, So 1,000 divided multiplied by 5, that's 5,000. Yeah, that's 5,000. So under absorb, you add it on the cost of production as I mentioned. Why? Because it is under absorbed and we need to add it based on the fixed cost element. So if you add them together and this minus, that you should find 35,000. And in order to calculate the gross margin, easy, this is sales minus cost of sales here. This is a product cost per unit. Now comes to period cost per unit. When it comes to period cost per unit, what you need to do, you need to minus the selling and admin expenses. And in the question, if you look here, you will see that selling and distribution expenses are fixed and variable. We have two elements for selling, distribution, and administration expenses. We have fixed selling 10,000 per month, and we have also the variable 15% of the total sales. So for the fixed selling, that's very simple. You just put it here, which is the 10,000, but for the variable element you need to multiply 15%. Why? Because the question, it does tell you that 15% of the sales value, in this case the total sales value, if you remember, is 75,000 pound, and then you need to multiply by 15%. That comes with 11,250. So if you add the selling cost together, that's 21,250. So of course, if you take away 40 from this, that comes with 18,750 pound is the operating profit for April under absorption costing. So it's very simple, straightforward. Only look at the trick here, which is the under absorption costing. So under variable costing, the second statement, sales is the same. There's no change in sales really. Sales is absolutely the same here. So what you need to do here, really, you need to start looking and calculate the cost of sales. So remember, when we calculated the product cost per unit, remember it's 15 pound. Why is 15 pound? Because we didn't include the fixed production overhead per unit. So 15 pound. So what you need to do right now, so cost of sales here, add cost of goods manufactured would be 2,000 units produced times 15 pound, and we have the ending inventory. Remember, we left with 500 units times 15, that's 7,500. This is cost of sales. One important thing here, if you noticed, we didn't include the over or under absorbed. Remember, with variable costing method, you do not need to worry about it. Before we calculate the contribution margin, if you remember, we need to deduct the less variable selling and admin. This is a variable element and we need to include it here. So 11,250, if you remember. Why? Because this is 75,000 total sales value times 15%. So the answer would be for contribution margin would be 41,250. So this 75,000 minus 250 minus 11,250 equal 41,250. Or what you can do, you can add up the 22,500, you add it up to 11,250, and then you take away from 75,000 pounds. So you will reach for contribution margin 41,250 pounds. Okay, so now what the end here for variable costing is, you need to deduct the fixed manufacturing overhead, if you remember, which is 15,000 pound. If you look at the question, is 15,000 pound, and also you need to deduct also the fixed selling and admin, because we did say that under period cost we include all the fixed elements here, including the manufacturing overhead and also the fixed selling and admin. So that's 10,000, and you know from where, so the 10,000 pound comes from here, the fixed selling and admin. So now if you look here, you will see that the total profit is 16,250 pound under variable costing. So as you see, there is a closing inventory. In this case, if there is a closing inventory, you would expect a difference in a profit. And in this case, what you need to do, guys, you just need to do the reconciliation. How to do reconciliation? You take the difference between the operating profit under absorption and the operating profit under variable. So if you add up the operating profit under variable, which is 16,250, if you add up the manufacturing overhead cost deferred in inventory, which is, I hope you remember that what we need to do, you need to look at the closing inventory, which is the 500 units here. Yeah, and that's 500 units. You multiply it by the fixed cost per unit, and in the question, if you look here, the fixed cost per unit is £5. Yeah, so that's 2,500. 2,500. So if you add up the profit, you should end with absorption costing profit of 18,750. And this is question number 1. Very simple, very straightforward. Just you need the trick here about under absorption costing. Right, now let's have a look at the question number 2. Let's have a look at the question number 2. For question number 2, we have a production to 500 units, and also we have sales to 300. No opening inventory. Yeah? The selling price per unit £90, direct material per unit 15, labor 18, variable production overhead 12, fixed production overhead 30, and the variable selling overhead £1. Fixed production overhead for the period 50 to 500, and the fixed admin 13,500. So what you need to do right now, really, you need to follow the same steps of same as the question number 1. Now, the first thing you need to do, you need to calculate the product cost per unit using the 2 methods. Okay, let's now look at absorption costing. So what is the product cost per unit? If you remember, the product cost per unit including the material, including labor, variable production overhead, and fixed production overhead. You do not include the variable selling overhead here, because anyway, variable selling overhead is under period cost. You don't include it anyway. So 15 plus 18 plus 12 plus 30, that makes 75 pound, right? So £75 per unit is the product cost per unit using absorption costing. So under variable costing, the product cost per unit would be the £75 minus what? Minus the fixed production overhead per unit £30. So that's equal £45. Remember that we produced to 500 here. And remember, we sold to 300. So we start with sales to 300, multiply the selling price per unit 90. Let's have a look. So now, as I mentioned, 2,300 unit sales, you multiply 90, which is the selling price per unit. So that's 277,000 pounds. So now if you look at the cost of sales, what you need to do here, so 0 of course is the opening inventory. You need to add the cost of goods manufactured. So the units we produce 2,500 units, and this you need to multiply by 75 pound, as we did calculated. 75 pound is the product cost per unit using absorption. You need to less the closing inventory. Remember that we have 200 units closing times 75 again. Why 200 units? Remember, because we produced here 2,500 units, and we ended with what? We ended with 2,300. So in this case, I would say that 200 units left, isn't it? Yeah, would you agree? Yeah. So that's 200. You multiply by 75. That comes to the closing inventory. Now, the trick. Now you need to stop yourself and think about the absorption for over and under absorption. So if you look here, what happened right now? Let's have a look. Usually when we figure out the over or under absorption, we look at the budgeted units, the budgeted production units, and also we look at the production units happen to be in April or May, whatever. Okay. The interesting thing here that the question does tell you how many units they have produced for April. Is that in April or not? Period 2, but the question doesn't really give any information about the budgeted production units, and that you might find it difficult to figure out how can you identify if there is an over or under absorption. So what you need to do right now, have a look. If you look here, the question does tell you that the fixed production overhead for the period were 52,500. This is the fixed production overhead for the period. Right. Now, if you look here, right? If you look here, what you can see that the production overhead is 75,000 pounds, actually not 52,500. Why? Because we produced, how many we produced? If you remember, we produced 2,500 units, right? We produced 2,500 units. If we multiply it by the fixed cost production overhead per unit, 30 pound, right? That comes with 75,000 pounds. 75,000. This is the production overhead under the or based on 2,500 units. But the actual production overhead is 52,500. It's not 75,000. It's 52,500 pound, and this is the actual one here. In this case, so you understand that we are over absorbed. We are over absorbed. What does it mean over absorbed? This means we produced more units for period 2. Why? Because the production overhead for period 2 is higher than the actual production calculated based on the units or the the budgeted units. In this case, what you need to do, you just need to take the difference between 75 and 52, and that's over absorbed, and you need to deduct it here less over absorbed. And remember, when I said that over absorbed, you deducted from the actual cost, because you cannot charge me extra if I produce more based on fixed cost element of fixed cost per unit. We did say that variable costing is justified, but not the fixed cost element. This is why we need to deduct it from the actual cost, because it's not justified. So that's 150,000. That's the cost of sales, and then the gross margin would be the 207,000 sales minus the 150, that's 57,000, the gross margin. Now what you need to do, you need to do the period cost, including the fixed selling and admin, and including also the variable selling and admin. So if you look at the question here, okay, right, it does tell you that we have variable selling per unit £1, and how many units we have sold? We have sold 2,300. So 2,300 units times £1 equal 2,300 pound, as you see. Okay, and also you need to add here the fixed element of selling and admin, which is, as you see, it's in the question, it is 13,500. 13,500 fixed administration overhead were 13,500. So you need to add it here. So if you add them together, that's 15,800. So would be the gross margin. You take away the 15,800, that comes with 41,200 pound is the profit for the year under absorption. Now the profit for the year under variable is the same way, but remember, no over or under absorb. And what you need to do, you need to calculate the product cost per unit, which I did, and it is 45 pound per unit. If you noted this, so 207,000 sales, no change, easy, yeah. And we have opening inventory, nothing. Cost of sales, cost of good manufactured, easy. We did say that 2,500 the units produced, you need to multiply by 45 pound, and we did say 45 pound is what is the product cost per unit using variable costing. Ending inventory or closing inventory again is 200 times 45, because there is 200 left, and that you multiply by product cost per unit 45. So that's 103,500. What you need to do, if you remember, you need to list the variable selling and admin, which is 2,300. This is the variable selling and admin. So if you do this, you should find out the contribution margin is 101,200, which is sales minus cost of sales. Last, you need to deduct the fixed selling, which is 13,500, and you need to deduct the less fixed manufacturing overhead, because these two are considered to be period costs under the variable costing element. So the total profit available would be the 35,200 pound under marginal or variable costing. So the last step, you need to do the reconciliation, and very simple. The way you do it, if you remember, so you need to start with the variable cost profit, which is 35,200, and you need to add up the fixed manufacturing overhead cost deferred in inventory. And how you do it, if you remember, you need to find out what is the closing inventory, and the closing inventory in units is 200 units. 200 units left. from the inventory, and this you need to multiply by the cost, the fixed cost element, £30. The fixed cost element here is £30. So that's 6,000. So if you add up 3,500, if you add it to 6,000, you should find out that the absorption costing profit is 41,200, and as you see is the same profit here. That's the reconciliation. Okay, so for question number 3, it's a theory question. The advantage, disadvantage of absorption and marginal costing. This is a written question, theory question, so you can basically research on this question from the internet, from different sources, and just find out what is the main, or what are the advantages and disadvantages of the two methods of costing, which are the absorption costing and marginal costing. Thank you very much and have a lovely day. Take care, guys. Bye bye.